Let's bring in PIMCO's Erin Browne. Erin, it's great to have you here. We have a day when some of the economic slowdown risks are more front and center than they have been some other days. The consumer confidence numbers, UPS results, and some more of these regional Fed bank business surveys that really have been rather weak. I guess the big question is, now that we have seen this rotation toward defensive sectors and bond yields come back in, is the market correctly priced for what's to come in the economy?
I don't think it is. I mean, keep in mind that the market on a year-to-date basis is still up 6.25%, and stocks are trading and flirting with 4,100. You know, we're not seeing, significant levels of fear in the absolute level of stocks, nor in valuations. They're still trading at, 18.5 times forward multiples, so still trading, fairly rich. I think that certainly today is a significant hit on a one-day, look-back basis. But when you take a larger step back and look at where the market's trading today, there's really a lot of complacency that's still priced into stocks.
I know that you were looking at the unusually low realized and implied volatility levels in the market coming into today and thinking that it was a pretty good bet to maybe essentially play a potential rise in volatility. We got some of that today. Do you think that we're in for something worse, or is this a routine pullback?
No, I do think that you'll likely see over the course of the next couple of months, as we start to see debt ceiling really come front and center and discussed in the market, as you start to see the economy roll even harder. I do think that volatility sub 20 is pretty remarkable, and I would expect to see that you would be trading in a more normalized 20 to 30 range over the course of the next 6 months or so. So from here, I would be betting on volatility moving higher. There's a lot of risk on the horizon, and the market's really not priced for that risk.
Given that's the case, it's interesting that you still are pretty warm toward the big global banks. Why would that be the case here?
So I think that the large cap banks, what we call as the globally systemically important banks, are going to be the beneficiaries of some of this pullback that we're seeing, across deposit flows, across lending in the smaller banks. Ultimately, we now have a significant number of assets that need to be sold by another bank. And who's going to be stepping in to buy those assets? It's going to be the larger banks, the capital providers that are able to step in and really take advantage of dislocations in the market and dislocations in the banking sector. And I think that, these large, globally systemically important banks are going to be the ones that ultimately are going to be the winners, 3, 6, 12 months down the line. So I like stepping in periods of weakness like today in, the large cap banks. I think that you'll be a beneficiary in the medium to long term. Sure, today, you take a P&L hit, but ultimately, they're the winners of capital outflows from the small banks and the winners of some of these asset sales that are going to be taking place over the course of, the preceding couple of quarters.